Hello everyone, trust you are all having a great day. It's a great day for me for sure that I am bringing to you Experts Take, powered by CredAvenue, India's largest debt marketplace. Experts Take is a CredAvenue's initiative to bring you the leaders, founders, visionaries and veterans and let them share their experience, outlook and inspiring stories all with us. Today, it's my pleasure to introduce you our guest and speaker. He needs no introduction, especially to anyone from Indian banking and NBFC domain. I'd like to welcome founder and chairman managing director, Mr. Kamlesh Gandhi, and he is a co-chair of FIDC. Mr. Kamlesh Gandhi, along with Mukesh sir, founded EMAS in 1995 to cater to low and middle income customer segments across products, where we see monoline products offered to small and mid-sized NBFCs. MAS has always been offering multiple products and successfully managing across asset classes. Under his leadership, MAS has been able to not just grow steadily and then manage multiple crises over the last 3 decades, which is itself a remarkable story. MAS as an organization and Kamlesh sir personally has been an inspiration to many founders and startup NBFCs. Kamlesh sir has been a guide to many of them through their journeys. Through the journey, MAS has also been engaged with such startups including fintech, microfinance, two-wheeler, housing, MSME, lab, and all asset classes. Through this engagement, he has not only handheld but harnessed the strengths and then leveraged these strengths for the benefit of both organizations, the fintech as well as MAS. So these synergies have been across organization structure, the agility that you brought in, the balance sheet that you brought in, the technology, sourcing, underwriting, collection strengths of both organizations. I think it's phenomenal journey altogether. Thanks a lot, sir, for agreeing to talk to us, and it's an absolute pleasure again to be chatting with you today.
Thank you so much. My pleasure to share my views on CoLending. And as you rightly told, we have been our endeavors in this space has been now for more than 27 years. Yeah. And we are focused on a particular segment, which is the real growth driver for the economy, namely micro, small and medium entrepreneurs. And we serve to them through our multiple product offerings. And what we have realized is that serving this class is not a function of your balance sheet size only. It is about the understanding of the demography and going by the dictum of extending credit where it is due, where you have to give to the extent what you should give. Understanding of demography plays a very important role in absence of getting the real documents what we need for assessing the real credit strengths. But just add to that, even though you have all the documents, understanding of the demography plays a very important role. So I firmly believe that serving the informal class is a function of creating a very strong value chain. It is not one NBFC versus the other, it is one NBFC along the other. So right from the banks. So just to take you back, this fundamental of lending is that we see to that the money reaches from the saver to the consumer. Maybe for livelihood, or maybe for running the business, or maybe for their personal need. Now, quality intermediation plays a very important role, because there is not a business of pass it on no return. You need to, a good intermediary is an intermediary who absorbs shocks and at the same time is very efficient in extending the last mile delivery of credit. So that is where creating a strong value chain among NBFC plays a very important role. And that is where we have a very active model in distribution, that we work with more than 150 NBFCs of the country. And we have found them to be a very high quality intermediary, evident from the fact that cumulatively we must have disbursed more than 15,000 crores, and the net loss given default has been less than 1%, and that too only because of this COVID crisis or one or two unfortunate events that happened in the industry. Otherwise, this sector had proven to be a very good intermediary. And they might have absorbed the shocks through by adding the capital, or through their internal accruals, or through the resilience in operations, whatever it may be. But we have been very happy that we selected this model of distribution along with our distribution of more than 4,500 centers spread across 6 states. So once again, to reiterate, a quality value chain will really bring about much more higher efficiencies in the delivery of the credit in the last mile.
Thanks, sir. Thanks for that. It actually sets up for the subsequent conversation I wanted to have with you. In fact, when I was preparing for this session, what I realized was MAS, even before the co-lending guidelines came in, you have started on firmly on. You have been a pioneer in the partnership model. You have encouraged joining hands with multiple stakeholders, like you rightly said, an ecosystem play or a value chain play, to deliver a win-win, not for just MAS but for the intermediary as well. I think it's something that you have delivered for more than 2 decades, and it's a exceptional story. So, sir, I think taking cue from that, and then with this context, let me ask you, by asking you, for your vision for co-lending, and how you think co-lending is a model which is going to unlock the potential of the MSME as well as the consumer lending. So your vision, and then how this is going to unlock the potential.
So as you rightly remarked, we had visualized this opportunity long back. As I shared with you that we were into this business right from 2010, not considering any of the NBFCs as competitor, but playing a complementary role. And once again, to reiterate, a value chain is the ultimate answer for efficient last mile delivery of credit. Sure. Now, as they say that the time of every product comes. So when we introduced partnership, we were new and we were the pioneers. And that whenever you pioneer something, there's a lot of resentment. So there were times where NBFC will tell that no, I like to build my book only. Why I should write for you, or why I should follow your credit screens, and so on and so forth. And the way we used to explain them is that you have to play on my balance sheet and I have to play on your distribution. So the right way is that let me have the access to what I should, and that will give me the room to take more credit exposures, and ultimately you will be in a position to serve your borrowers. And we were successful to a great extent in our endeavor of building a partnership with NBFCs. And currently, with this co-lending being so familiar, thanks to the vision of Reserve Bank of India, where primarily they believe co-lending between banks and NBFCs can be between NBFCs, bigger NBFCs to smaller NBFCs also, because we know that there is a size arbitrage in lending, that the bigger ones to the smallest one. At the same time, there are expertise arbitrage also, that the smallest being the most expert in that particular field, while the largest might not know that demography that good. So now with this concept of co-lending becoming more familiar, the resentment is quite less, and we start from a certain stage how we will do co-lending. First it was why we should do co-lending, and now it is how we should do co-lending, and that has made our job quite easier. And going forward, we will have co-lending both the ways, on the asset and the liability side. So that will be so that's the real intermediation role will play. And once again, I firmly believe that basically all of us play a role in connecting the saver to the user. And the more efficient, the more the efficiency is there, the more credit can be dispensed, the more credibility you can create and more confidence you can create among the savers to channelize the savings through this intermediary channel. So I think we are definitely benefiting from this recent co-lending atmosphere or ecosystem which is building up and getting familiar.
Thanks for that, sir. I think you made a couple of interesting points there, that expertise arbitrage, I think is extremely well put. And then you also mentioned about not just co-lending limited to asset side of it, but also liabilities. I think you actually are making pertinent questions, and then the bridge that you are telling from a saver to borrower, I think it's a very, very interesting point. So, sir, in this regard, when you are talking about lending, so how do you think co-lending is going to, as a product, bridge the gap, especially the credit gap in this country? Because we see there is huge, financial inclusion problem. So, how do you think the credit gap is going to bridge, especially with the co-lending as a product?
I'll call it, this is a step in the right direction to bridge the gap. Co-lending alone will not be possible to bridge the gap because there is an enormous credit gap, and you need to have various tools to bridge that gap, including the financial literacy and market linkage is what you need for borrowers. Because when we talk about bridging the credit gap, you only think about the supply side. You also need to think about the quality of the borrowers and how they not only demand credit but they command credit. That completes the circle of bridging the gap. It's not a one-way traffic. Having said that, as I shared with you, this is a step in the right direction. Everybody will work on their own forte. And secondly, running an NBFC for more than 2.5 decades, we have witnessed that at any size, when your assets ready, liabilities work in progress and vice versa. So when you have anchored your liability through co-lending, everybody can concentrate on their own forte. Sure. And that will definitely bring about more efficiencies within the system, and that will increase more credit dispensation to the ones who really need it. And I think this co-lending has a very important role to play. Having said that, every good idea is as good as it is executed. So I'm a firm believer that lot of transparency based on the understanding. Every time it is not so that the transparency is not there intentionally, but because of lack of understanding. So both the co-lending partners need to understand the product dynamics, they need to understand the operational dynamics, the cost dynamics thoroughly, and then work for scalability. That only will ensure sustained scalability. And there are going to be hiccups. The direction is right, but there are going to be hiccups, operational hiccups regarding the understanding and all. But I think it is incumbent on all of us that this model should succeed. And for any model to succeed, everybody has to work together. And I think currently we all are working this in the right direction. But I would once again urge all the players to see to that there is sufficient amount of understanding, be it commercial, be it operational, be it sharing the losses, and everybody plays to their own forte and understand the market in the real sense. That will accord sustainability and scalability.
Again, a few pertinent points that you made. Any model is as good as execution, and then there are inefficiencies. There are bound to be inefficiencies, and everything is a work in progress, like you rightly said. So, sir, completely in sync with in fact, it leads into my the next question that I wanted to ask you. As an industry expert, having seen the model over the years, over the last 2.5 decades and all, and then with the current guidelines that are there, we acknowledge that it is a step in the right direction, but we need to, it's a work in progress, everything, right? So what are the a few challenges or major challenges in the current co-lending model and setup that you see, and then that we need to talk about? First of all, acknowledge that there is a gap in the co-lending infrastructure that we have in the country for us to be able to unleash it. So, what do you think are the key challenges?
Starting on an optimistic and positive notes, there is a lot of convergence strategically. Sure. That I have been on both the side, on the co-lending, on the liability and the asset side. So in the boardrooms and the conference room, we think that okay, we'll start getting the business right from tomorrow, and this will be the quarterly targets and half-yearly targets and so on and so forth. But practically, there are a lot of challenges, so to say. Sure. But they have solutions. And as I told you, that solution revolves around the better understanding of the product and better understanding of the partners. You cannot look the other way when it comes to operational issues. Right from accounting issues to sharing the profits, right from understanding that the originator partner has to incur operational expenditure. It is not just a ratio of 80-20 between rate of interest, that on 80% it is 8%, on 20% it is 12, so it is 10. It is not as simple as that, because the operational cost is on complete 100%. The delinquency reserves has to be created. So we see a lot of challenges at the ground level for the people to appreciate and understand this. The simple understanding is that it is if it is 8% of the lander, it is 8 multiplied by 80%, it is 6.4, and 10% it is 2. So the ultimate lending is 8.4. It doesn't happen like that, and that is the biggest challenge to explain to the lenders and also in turn to the regulators that how exactly it works out, because it is all about operational cost. Now you have to understand that why co-lending. Co-lending is because there are a special expertise and cost is involved in distributing small time credit. And then you have to appreciate the associated things with it, be it cost or be it delinquencies. So I think there is lot of ground to cover in understanding the operational issues, which I think over a period of time we will be in a position to discover ways to understand and solve this.
Sir, you mentioned about, I think if I understand this fully, you said, we need to educate, bring everyone in the ecosystem up the curve, all the stakeholders. I think, show the points. Probably, I'd request your views on technology also. As co-lending, to, like you also mentioned that it's as good as execution, and to execute it, when you go on to, on the ground, talk about accounting issues, operations issues, what I also hear about is technology. At the end of the day, without technology, it is excellent on paper, excellent on Excel sheet, it's a win-win proposition. But you go on to execute it at that scale, especially at the small time credit that you're talking about, technology would play a key role. So what's your take on technology and co-lending, and then it being the game changer to be able to unlock the potential, that co-lending is present to the country?
Can't agree with you more. And I'll use the word, it's a game starter, not the changer. To start co-lending, technology plays a very important role. Because here there is a lot of element of trust between two partners.
Sure.
And as it is famously told, and I think that the legendary Narendra Modi always tells that in God we trust, but in data we should trust more. So the trust builds on the flowing of data. And if there is a real-time flow of data, then we can take corrective actions at the right time. We can understand the things in the right perspective. So I'll once again reiterate, technology is the first starting point where there is a seamless data flow, where there is a seamless platform whereby two borrowers being different entity looks one on operations, whereby each one can exercise their control to the extent agreed and they should. So all these things is possible only by use of technology. Right. And let me add you that platform like CredAvenue can play a very important role in this. But I will add a caveat here, you have to constantly evolve. It's a task to be worked up or not worked out. Yeah. What suits for two partners might not suit for another two partners. And very important, being a user of a platform, one of the biggest apprehension people carry is on the data privacy and data secrecy. So there's a lot at stake when it comes to sharing data on a particular platform. So all the technology platform needs to be aware of the fact that they carry an enormous risk in terms of integrity of data, in terms of giving the real-time data analysis and the real-time data dissemination. Because once we place ourselves on a particular platform, we are guided by the platforms. We have very little in our head. Absolutely. That once we are through on your program or once you are through on your platform, practically we are dependent on you.
Sure.
And that puts a lot of responsibility on the platforms to understand that what is required, how to evolve over a period of time and constantly improve. But I don't think that this is scalable or sustainable without the use of optimum and the right technology.
I think key points that you mentioned about data responsibility on platform like ours, the CredAvenue, we are trying to play a role, info security or data security. I think there is a lot that we need to invest back into the technology so that, like you rightly mentioned, it has to be a task which has to be worked upon continuously and then evolve. And then it is, like I said, there is no standard solution anywhere there right now. I think we need to work upon. So there is a lot of investment back into the technology that we need to, or say product that we need to, do so that we unleash it. So now I would like to again take you back, sir, in the journey, especially from the perspective that you have seen partnerships model when technology was also very nascent as we see it now. Even now, when you say technology is still a starter, imagine that you have been working on partnerships model for about 2 decades. So how have you seen these models evolve over 2 decades, sorry, and the way forward from that perspective, especially learnings for all of us in the ecosystem, and what is that that you want to give away?
So it, as I shared with you earlier, it started from convincing the partner that we should do partnership. It all started from them. And then what sort of data you will share with us from time to time. And you tell as a nation state, I say, in absence of technology, there was no technology, so to say. So there was there was and is to a certain extent a physical movement of files, and then a double credit assessment which puts cost on both the partners, both the parties, and that ultimately resulting into higher debt and maybe more inefficiencies. So from that level to bilateral tech use to a platform use. That is the journey what we are covering. And I think as we go along this journey, it will have more and more efficiencies within the system, and more and better control on both the sides. Otherwise, it was more of a business of relying on the partner more than what you should have relied. And as I shared earlier also, that from our experience, reliance to beyond a point is a risky proposition, and experience in finance means we have lost money like that. There is no experience in finance without losing money. You don't get experience only by reading books. That is just the knowledge. So technology will play a very important role in fixing the responsibilities and monitoring the role of each partners, thereby reducing the reliance on just depending on the trust on the other partner. As I told you, the data will replace, and data will reciprocate that trust, that we are getting this data, and because of this data we trust, and that will play a very important role in decision making, in exposures, and thereby the ultimate borrowers will be benefited.
Absolutely. I think, sir, the way you've actually so well put by you, how data and then trust and technology, the combination of all this, marriage of all the strengths that you talked about, ecosystem, value chain, building the value chain and the bridge across. So I think we are definitely at a cusp wherein we can see a lot of positives coming out of it, and probably we are in the right direction. So if I have to ask you, what is your take on the kind of volumes that we can see, or the way the potential of this market, especially for this country, given I'm not just talking about PSL lending, because RBI's guidelines are about PSL lending. It is also about consumer lending, and you also briefly mentioned about liabilities. So how do you see the entire potential panning out in the next 3-5 years?
Very difficult to put it and translate into numbers.
Sure.
But if what I personally think, that in terms, if I priority the sectors where it will play a very important role, it will be first starting from mortgages.
Sure.
Whereby maybe home loans or mortgage loans, which are relatively much safer, and where it really adds value for the originator to partner with a bigger balance sheet size partner. So in priority, it can start with mortgages, and then secured loans, and then MSME loans, and then the personal loans and all those things. But that will definitely be larger volumes going forward. How large, difficult to predict, because there are so many moving parts there. So it will be difficult to assign a number to that, but it will play a very important role in terms of number. And I think going ahead, it will only increase. But once again, we all are responsible not to create any mess here by just speeding up more than what we should, or looking the other way on critical parts, whereby we start doubting our own models. Otherwise, strategically and intrinsically, this model has a lot of strength. Sure. And I say that if managed nicely, this model will contribute significantly to the overall credit dispensation to the borrowers who really needs the funds.
Thank you, sir, and thanks for these valuable insights. And it's been an absolute pleasure and honor to be, catching up with you on this topic. And when we talk about experts take, who is a better expert than you? Talking about co-lending, partnerships, and the way forward for that. And really glad that we had this conversation. And thank you so much.
But thank you so much for this opportunity, and look forward.
Thank you so much, sir. Thanks, sir. Pleasure.